Welcome back to UK Property Info. What I'm about to share with you today could be the most important analysis we have ever published on this channel. The Bank of England is approaching a rate decision that has the potential to fundamentally alter the trajectory of the UK housing market for years to come. This is not hyperbole or sensationalism designed to grab your attention. This is a sober assessment of where we stand at this precise moment in history and why the next announcement from Threadneedle Street could push an already fragile housing market past its breaking point. If you own property, if you are trying to buy property, if you have a mortgage, or if you simply care about the economic stability of this country, you need to understand what is at stake in the coming weeks. Let me set the scene for you with some context that explains why this particular rate decision carries such extraordinary weight. Over the past 2 years, the Bank of England has implemented the most aggressive series of interest rate increases in over 3 decades. We went from a base rate of just 0.1% in late 2021 to over 5% today. That represents a 50-fold increase in the cost of borrowing in a remarkably compressed time frame. To put that in perspective, someone who took out a mortgage when rates were at their floor is now facing monthly payments that have potentially doubled or even tripled. The housing market has absorbed these increases with remarkable resilience so far, bending but not breaking under the pressure. However, there are clear signs that we are approaching the limits of what the market can withstand, and the next rate decision could be the one that tips us over the edge. The fundamental problem we face is one of accumulated stress. Think of the housing market like a bridge that has been bearing an increasingly heavy load. Each rate increase adds more weight to that bridge. For a while, the structure holds because it was built with some margin of safety. But there comes a point where one additional ton causes catastrophic failure. Not because that single ton is so heavy, but because it exceeds the total capacity of the structure. That is precisely where we find ourselves today. The housing market has absorbed rate increase after rate increase, but the cumulative stress is now visible in every metric we track. Transaction volumes have collapsed. Price growth has reversed. Mortgage approvals have fallen to their lowest levels in years. The bridge is creaking, and everyone is watching to see whether the next load will be the one that brings it down. To understand why the next rate decision is so critical, we need to examine the mortgage time bomb that is currently ticking beneath the surface of the housing market. During the years of ultra-low interest rates, millions of homeowners locked into fixed-rate mortgage deals that offered extraordinary value. 2%, sometimes even lower, fixed for 2 or 5 years. Those deals felt like free money at the time. Borrowers stretched to afford larger properties because the monthly payments were so manageable. Lenders approved bigger loans because affordability calculations looked so favourable. The entire market operated on the assumption that cheap money would last forever. That assumption has now been shattered, and the consequences are only beginning to emerge. Here is the truly alarming statistic that should concern everyone watching this video. Approximately 1.6 million fixed-rate mortgage deals are scheduled to expire before the end of next year. That is 1.6 million households who will transition from rates of 2 or 3% to rates of 5 or 6%. For an average mortgage, that translates to an increase of somewhere between £300 and £500 per month. For many families, that is the equivalent of losing a part-time salary. For some, it will mean the difference between financial stability and genuine hardship. And for a significant minority, it will make their mortgage payments genuinely unaffordable, forcing them to sell their homes in a market that may already be falling. The Bank of England is acutely aware of this situation, which is why the next rate decision carries such significance. If they raise rates further, they accelerate the financial pressure on these households and increase the likelihood of a wave of forced sales that could crash property prices. If they hold rates steady, they risk allowing inflation to remain elevated, which creates its own set of economic problems. And if they cut rates, they might be seen as capitulating to market pressure and undermining their credibility as an inflation-fighting institution. There is no easy option here. Every path forward involves significant risks and trade-offs. The question is, which risks the bank considers most acceptable, and what that means for property owners across the country. Let me walk you through the 3 scenarios that could unfold following the next rate decision and what each one would mean for the housing market. Scenario 1 is a further rate increase. If the Bank of England decides that inflation remains too high and raises rates by another 0.25% the impact on housing market confidence would be severe. We have already seen buyer sentiment collapse to levels not witnessed since the 2008 financial crisis. Another rate increase would confirm the worst fears of potential buyers and likely trigger an acceleration of the price falls we are already witnessing. More importantly, it would push mortgage rates even higher, taking typical 5-year fixes above 6% and potentially towards 7%. At those levels, vast swathes of the population are simply priced out of home ownership entirely. The knock-on effects of a rate increase scenario would ripple through every corner of the property market. First-time buyers, already struggling with deposit requirements and affordability constraints, would retreat even further from the market. Existing homeowners approaching the end of their fixed-rate deals would face even more brutal payment increases. Landlords, many of whom are already operating on razor-thin margins, would be pushed further towards selling their portfolios. The buy-to-let sector, which has been hemorrhaging properties for years, would see an acceleration of the exodus, and property developers, already scaling back their construction programs, would shelve even more projects as the viability calculations become increasingly unfavourable. The cumulative effect would be a market in genuine freefall, with prices potentially dropping 15 to 20% from their peak in a matter of months. Scenario 2 is a rate hold, where the Bank of England decides to pause and assess the impact of previous increases before making any further moves. This might sound like the safest option, but it comes with its own set of challenges. A hold would provide temporary relief to the mortgage market, potentially preventing further increases in borrowing costs. However, it would also extend the period of uncertainty that has been paralysing both buyers and sellers. When people do not know where rates are heading, they tend to freeze in place, rather than making major financial decisions. A hold might prevent immediate damage, but it would not restore the confidence that is necessary for normal market function to resume. Properties would continue to sit on the market for extended periods. Chains would continue to collapse, and the sense of drift and malaise that has settled over the housing market would deepen rather than lift. There is also a credibility dimension to consider with the hold scenario. The Bank of England has spent the past 2 years emphasising its commitment to bringing inflation back to target, whatever the cost. If they pause rate increases while inflation remains above target, some will interpret this as a loss of nerve. Financial markets might begin to question whether the bank will follow through on its stated intentions. This could actually cause mortgage rates to rise even without an official bank rate increase, as lenders price in the risk of inflation remaining elevated for longer. The irony is that a hold designed to provide relief could end up causing the very pain it was intended to prevent if markets interpret it as a sign of weakness. Scenario 3 is a rate cut, which might seem unlikely given current inflation levels, but is not entirely beyond the realm of possibility if economic conditions deteriorate rapidly. A rate cut would provide immediate and dramatic relief to the housing market. Mortgage rates would fall, improving affordability overnight. Buyer confidence would surge as people rushed to lock in deals before any reversal. Transaction volumes would likely spike as pent-up demand was released. Property prices, which have been drifting downward, might stabilise or even recover some lost ground. For homeowners worried about negative equity and forced sales, a rate cut would feel like a lifeline thrown at the last possible moment. However, a rate cut in the current environment would come with significant costs that we cannot ignore. It would almost certainly cause inflation to remain elevated for longer, eroding the purchasing power of everyone in the country, particularly those on fixed incomes or those without property assets. It would reward those who took on excessive debt during the cheap money years, while penalising savers who did the responsible thing. And it would potentially store up even bigger problems for the future by preventing the necessary adjustment in property prices that would make housing more affordable for the next generation. The sugar rush of a rate cut might feel good in the short term, but the hangover could be severe. Beyond these three scenarios, there is a deeper structural issue that we need to discuss. The UK housing market has become extraordinarily dependent on cheap credit over the past 2 decades. When interest rates were near zero for over a decade, property prices inflated to levels that only made sense if borrowing costs remained permanently low. The average house now costs approximately 8 times the average salary, compared to around 4 times in the mid-1990s. This is not a sustainable situation, and it was always going to require some form of correction. The question is whether that correction happens gradually and manageably, or whether it happens suddenly and catastrophically. The Bank of England's rate decisions will largely determine which path we take. I want to spend some time discussing the regional dimension of this crisis because the impact of rate decisions is not felt equally across the country. London and the South East, where property prices are highest in absolute terms, are most exposed to rate-driven affordability pressure. A buyer in London might be looking at mortgage payments of £3,000 per month for an average property, compared to £800 in parts of the north. When rates increase, that London buyer sees their payments rise by potentially £600, while the northern buyer might only see an increase of £150. This mathematical reality means that the south is experiencing a much sharper correction than the north, and this divergence will only intensify as rate decisions continue to bite. The regional picture is further complicated by the different housing stock in various parts of the country. London has a much higher proportion of flats and leasehold properties, which face their own unique challenges around ground rents, service charges, and cladding issues. These additional costs, layered on top of rising mortgage payments, are making London property ownership increasingly unattractive to many buyers. Meanwhile, cities like Manchester, Birmingham, and Leeds are seeing relative resilience in their housing markets, partly because prices never reach the same extremes, and partly because local economies are creating genuine demand. The next rate decision will affect all regions, but the degree of impact will vary enormously, depending on local market conditions. For those of you who are currently homeowners with mortgages, I want to provide some practical guidance on how to navigate the uncertainty surrounding rate decisions. First and foremost, know your exposure. If you are on a fixed rate deal, understand exactly when that deal expires and what your options will be at that point. Start shopping for remortgage deals at least 6 months before your current fix ends, as you can typically lock in a rate and then decide later whether to proceed. If rates fall before your new deal starts, you can simply find a better offer. If rates rise, you have protected yourself by acting early. This simple strategy of securing an early remortgage offer is one of the most effective ways to manage rate uncertainty. For those on variable or tracker mortgages, the situation is more challenging because you are directly exposed to Bank of England decisions. Consider whether switching to a fixed rate makes sense for your circumstances, even if the immediate cost is higher. The certainty of knowing exactly what your payments will be for the next 2 or 5 years has genuine value in an environment of such uncertainty. Yes, you might end up paying slightly more than if you had gambled on rates falling, but you also eliminate the risk of being unable to afford your home if rates spike unexpectedly. For most families, that insurance is worth the premium. If you are currently trying to sell a property, the rate decision environment creates specific challenges that require careful navigation. Buyers are extremely rate sensitive right now, and any hint of further increases tends to cause hesitation and offer withdrawals. Price your property realistically from the outset, rather than testing the market with an ambitious asking price. Properties that are correctly priced are still selling, even in this challenging market. Properties that are overpriced are simply languishing without viewings, growing stale on the portals, and eventually requiring embarrassing reductions that make buyers wonder what is wrong with them. Your ego might want you to list high, but your bank balance is better served by listing right. For prospective buyers waiting on the sidelines, the rate decision creates a genuine dilemma. On one hand, waiting for rates to fall could mean lower mortgage payments and potentially lower property prices. On the other hand, waiting means continuing to pay rent, missing out on any house price stabilisation that might occur, and potentially facing competition from other buyers who have been waiting for the same moment. There is no universally correct answer here. What I would say is that if you find a property you genuinely want to live in for the long term, and you can afford the payments at current rates with some margin of safety, the rate decision should not be the primary factor in your decision. Homes are for living in, not for trading. If your financial situation is secure and the property is right, the precise timing of your purchase matters less than you might think. The landlord community is perhaps facing the most acute pressure from rate decisions, and this has implications that extend far beyond property investors themselves. As mortgage costs have risen, the mathematics of buy-to-let have become increasingly challenging. Many landlords are operating with yields that no longer cover their mortgage payments, maintenance costs, and regulatory compliance requirements. Every rate increase pushes more landlords towards the exit, and we are already seeing the consequences in the rental market. Fewer rental properties means higher rents for tenants and less choice for those who need to rent. The Bank of England's rate decisions are thus not only affecting property owners, but also shaping the rental market in ways that affect millions of people who may never buy a home. I want to address the question of whether the housing market could genuinely break in response to rate decisions and what that would actually look like. When I use the word break, I am not suggesting that properties will become worthless or that the entire system will collapse overnight. What I mean is that we could see a period of severe dysfunction where normal market mechanisms stop working properly. This might manifest as a freeze in transactions, where buyers and sellers cannot agree on prices, and deals simply do not happen. It might appear as a wave of forced sales that overwhelms the market's capacity to absorb them. It might show up as lenders withdrawing products and tightening criteria so severely that even credit-worthy borrowers cannot obtain mortgages. All of these would represent the market breaking in the sense that it is no longer functioning as it should. The historical precedents for this kind of market breakdown are sobering. In the early 1990s, the UK experienced a housing crash that saw prices fall by nearly 40% in real terms in some areas. Negative equity trapped millions of homeowners in properties they could not sell. Repossessions reached levels that would be unimaginable today. The recovery took the better part of a decade. In 2008, the global financial crisis triggered another severe housing downturn, though government intervention and ultra-low interest rates prevented the worst outcomes. The question we face now is whether we are approaching a similar moment of reckoning, and whether the tools that saved us in 2008 are still available given the inflation constraints the Bank of England is currently operating under. The political dimension of rate decisions cannot be ignored, particularly with a general election approaching. Housing affordability is a major issue for millions of voters, and the government will be acutely sensitive to anything that worsens the situation. However, the Bank of England is nominally independent, meaning ministers cannot directly instruct it on rate decisions. This independence is valuable because it allows the bank to make economically necessary decisions without political interference. But it also means that if rate decisions cause significant housing market pain, the government will bear the political consequences, while lacking the tools to address the underlying cause. This awkward dynamic is already creating tensions that are visible in the careful language used by Treasury ministers when discussing monetary policy. Looking ahead, I want to share my assessment of where rates are likely to head and what that means for housing market planning. My base case is that the Bank of England will hold rates steady in the near term, allowing time to assess the impact of previous increases. I believe the bank recognises that the housing market is fragile, and that another increase could trigger consequences that would be difficult to control. However, I also think the bank is not yet ready to cut rates, given that inflation remains above target. This suggests a period of elevated but stable rates, which would give the housing market time to adjust without additional shocks. In this scenario, we would see continued gradual price falls, subdued transaction volumes, and ongoing pressure on those remortgaging, but not an outright crash. The risk to this base case comes primarily from inflation. If price rises prove stickier than expected, perhaps due to wage growth or energy costs, the bank may feel compelled to raise rates further despite the housing market consequences. Alternatively, if the economy tips into recession and inflation falls rapidly, we could see rate cuts sooner than currently anticipated. Either deviation from my base case would have significant implications for property markets, which is why continuous monitoring of economic data is essential for anyone with exposure to housing. For those watching this video and wondering what concrete actions they should take, let me offer some specific recommendations. If you have a mortgage, review your terms and understand your exposure to rate changes. If you are approaching the end of a fixed deal, start exploring your options now rather than waiting until the last moment. If you are considering buying, stress test your affordability at rates 1 to 2% higher than current levels to ensure you could cope with further increases. If you are considering selling, be realistic about pricing and prepared for a potentially lengthy sales process. And if you are a landlord, run the numbers carefully and honestly assess whether your portfolio remains viable in the current rate environment. The next rate decision from the Bank of England is not just another data point for economists to analyse. It is a moment that will shape the financial futures of millions of households across the United Kingdom. The housing market has absorbed enormous stress over the past 2 years, but there are limits to what any system can withstand. Whether we navigate through this period with a managed correction or experience something more severe depends largely on decisions that will be made in the coming weeks and months. Stay informed, plan carefully, and remember that in uncertain times, prudent preparation is always preferable to hopeful optimism. Thank you for watching this analysis from UK Property Info. If you found this breakdown valuable, please subscribe to the channel and hit the notification bell so you never miss our updates on the UK property market. Share this video with anyone who owns property, is trying to buy, or has a mortgage. They need to understand what is at stake with the coming rate decisions. Leave your comments below telling me how rate changes have affected your property plans. Are you holding off on buying? Are you worried about remortgaging? Are you considering selling? I read every comment, and your experiences help me understand how these policy decisions are affecting real people in the real world. Until next time, this is UK Property Info, helping you navigate the most important property market decisions of your life.